Let's talk a little bit about your book and what Catching Knives is all about, because there's some critical fundamentals in your book and, why a recession is the best time to invest in commercial real estate, how commercial real estate investing can create financial freedom, reasons your investing process should start with an exit strategy. Let's just hit on some of these key fundamental principles that your book teaches.
Profits are made by selling too soon. Because what happens is people are trying to time the markets. They're trying to time the bottom. They're trying to time the top. Be like, you can't. So if you just execute your plan, make your profit, because you're never going to go broke making a profit. Fundamentals are not the only thing that drive markets. I think what that is going to do is potentially cause the music to slow down and maybe in some markets even stop.
What's going on, everybody? This is Chris Naugle, and welcome back to the show. Today, I am joined by Jake Harris from Catching Knives. So how many of you go in your kitchen and just throw the knives up and try to catch them, the sharpest ones? Any of you guys do that? That's what Jake's an expert in. I'm just kidding. Catching Knives, and what he writes about in his book, is all about buying distressed commercial real estate. Does that sound pretty good? Yeah, a lot of you are thinking so, but distressed real estate is tough to come by now, but it is not going to be tough to come by in the near future, because if you are even paying attention and looking out the front windshield, you see what's coming. The next big recession, or maybe is it the Great Depression all over again? Folks, this is the knowledge you're going to need. This is what Jake talks about, what he teaches, and what his book's all about. And I'm honored to have him on the show. Jake, welcome.
Hey, Chris, I really appreciate it. Your show is, near and dear to my heart. Money, real estate. I always enjoy talking about this. People wanted to talk about real estate and money because I think it is so critical and intricate to everything we do day in and day out.
100%. A lot of people, when they're looking at commercial real estate, in today's world, they're looking around going, holy crap, everything's so expensive. Some people would say, oh my God, everything is so overpriced. Other people are saying, oh my God, rates are so low, even though we're paying the high price, it's okay. Let's get a little bit into the weeds on what your business is and what you do today. And then let's take a trip back in time to kind of how you began this whole journey.
Well, let me actually take you to a point. I was sitting on a street corner in Tucson, down the street from the university. I was working on this Adobe house, and I was crying, and I was praying to be worth no money. I was like, dear Lord, can I be worth no money? The reason is because I had a portfolio that was worth less than the debt that I owed on it. And actually, I was just thinking about this the other day. It was the effect of it. And actually, the house I was working on as a contractor, I was doing it for some extra money because I was so hard up for money. It was for the boyfriend of the girl that I thought I was going to marry. We had broken up. She had felt sorry for me. And this is fresh, like within, a month or a couple months of this. And she's dating this new guy, and he's getting ready to fix up or wants to flip this house or turn it into a rental, or I don't even remember. And I'm sitting there fixing up the house, and it is tearing me up inside just to be there and then see them pull up to the house and be lovey-dovey. And I'm so hard up for money because I owe all this money to banks, because I owe it to my investors, I owe it to other people, that I'm willing to do anything, include just throw and tear open my guts. And then I'm sitting on that street corner and I'm crying. And I'm just like, can I be worth nothing? No money, like just zero. Zero would be awesome to start over from that nothing point. And the reason I tell you that is because the quote that I put on the back of the book from Baron Rothschild is that the time to buy is when there's blood in the streets, even if the blood is your own.
I've never heard that about it. The blood being your own. That's good.
And I was like, it was my story. I was living that. I was the blood in the streets. The proverbial streets was mine. I'd got out of the Army. And really, if you want to take it back, my family, because he asked, when did I get started in real estate? My dad was a police officer, and before that, we bought this old house built in 1888. It was an old farmhouse on what was the head of an orchard in Central California, and we lived in a 16-foot camp trailer, a family of 5. Now, as a family of 5, I look around and I was like, dude, that is not very big at all. And so, but we lived on that and fixed up the house down to the studs, no foundation, jacked it up, and so I have pictures of me carrying a piece of plywood with my brother, taking baths in the wheelbarrow. And so essentially I grew up on a construction site. And so really when you look at it is the length of what I've been doing, it's been my whole entire life. It just has gone and elevated from levels to levels to levels. I went to the Army and I read this book, Rich Dad, Poor Dad. Somebody handed it to me and it was like, yes, this is what I want to do. I want to invest. I want to fix and flip. I want to do these things. So the early 2000s, and I set a goal and I wrote out a plan, and I wanted to be a millionaire before 30.
It's a good goal.
And I achieved it. And Robert Kiyosaki, I was living in Phoenix. I met him. I had to go hang out at Rich Dad Radio, and he was like, be cautious, young man. When you're taking on debt at 105%, and the real estate advisors around him, the Rich Dad advisors. And I was like, man, you just don't understand. I'm super smart. And I'm buying things at a discount. I'm buying it at 25% under market value. The market would have to go down more than 25% before it ever touched where I was as a position, even though it's at 105% of financing. You just don't understand. So then subsequently, you heard the beginning of that story of what I was starting was I was sitting on the street corner worth no money, negative money. So Robert Kiyosaki was right. I was wrong. And then subsequently, after the subprime meltdown, crying on the street corner, doing very introspective work and looking at things, I got back into real estate. Because this is what I was meant to do. This is the thing that I was put on this earth to do. And I needed that. I needed to go get kicked in the teeth to readjust and then retool and say, what do I do best? Now, how do I do more of that?
I like it. So the craziest part of that is the girl you thought you were going to marry, you're doing work for her boyfriend and they show up being all lovey-dovey. And just to make you feel better, usually when people show up lovey-dovey, they're usually pretty freaking miserable in real life. So I think that might've just been a show, but we'll just trying to make you feel better about that little part. But the funny thing is everything you just talked about falls into, everything we need to learn. You're going to fail. Life is full of different seasons. They're just like outside. Right now, we're coming into spring and the seasons are all temporary. So really all we need to do is survive the season. You just had to survive that season, but you got some wise advice. Well, you had to learn the hard way, but the wise advice was, don't overpay, don't over leverage, don't use debt the way so many people are. And today, I know you wrote your book during the pandemic, when you thought everything was going to fall apart. Here we go. Yes, everything's going to fall apart. Distressed properties. Here I come. And then what happened? The son of a bitch V'd went straight up and it's just been crazy, largely induced because the government printed over $5 trillion, largely induced because the Fed dropped rates to near zero. And we've been in this low interest rate cycle for quite a while now, and largely induced because hedge funds know what's coming to the stock market, are moving large chunks of money out of Wall Street and going to Main Street, buying up the properties that you and I want to buy, which then does nothing but hockey stick the real estate values. And it is an artificial increase, but it is nonetheless making a very different environment out there for people to buy real estate. So let's talk a little bit about your book and what Catching Knives is all about, because there's some critical fundamentals in your book and, why a recession is the best time to invest in commercial real estate, how commercial real estate investing can create financial freedom, reasons your investing process should start with an exit strategy. Let's just hit on some of these key fundamental principles that your book teaches.
Yeah. So I would say, spot on what you just identified, private equity, institutional capital. So I subsequently have done 1,200 flips, maybe 1,300 flips in 23 states. We've sold
that. I got it. That's why you have no hair left, because my hair started leaving and I was only at 270 flips. So if I would have continued, I would basically not have any hair left. Got it.
Yeah. So we sold to Blackstone, Invitation Homes, Tricon, Colony, all the big groups. We aggregated single family rental portfolios and sold them off. And so the reality was that's when I kind of went from, 2.0 to 3.0 was discovering that they were playing a different game. They were playing chess. I was playing checkers. And so I took my experience from how to fix up a property efficiently and cost effectively and was able to execute that. And I'm going to give you a story of where one of those points was, because I bought a lot of stuff at foreclosure auction. Distressed, you didn't actually even get to see inside the property sometimes. Sometimes you're buying properties, not really sight unseen, but you didn't know what the internal conditions were. So we would go buy them, and I'd buy a house. I would fix it up. I'd spend, whatever, $20,000, $30,000, $40,000 on fixing this up, and then sold it to these REITs or private equity groups or institutional capital and make a good return, 15, 20%, because they were buying in bulk. And so we're like, I just bought it. I fixed it up. I made a profit on the fix up. I made a profit on the purchase, and now I'm making 20%. Well, subsequently, they also were moving so much capital. They were kind of creating a vacuum in the market. And I thought, wow, what happens if they just buy everything and I can't buy anything? What am I going to do for my business model if this is evaporated? So I also became a vendor for them as a contractor to fix up these houses. So I bought a house, fixed it up, made a profit, sold it to them, make a 20% profit, and then I got a work order to fix up that same house. We'd sold them 5 or 8, 10 houses in a little portfolio, and I was like, wow. I mean, you look at a lot of addresses and after a while you don't really recognize them, but I was like, for some reason that stuck out. And so I went and checked it out and I was like, no, we've actually owned this. Like, we bought this house and it's turnkey, brand new carpet, brand new paint, brand new appliances. Cause we made everything, not pristine, brand new, but functional. And it was new carpet, new appliances, new. And I came in and I said, hey guys, like, this is completely remodeled. Like, literally, the carpet is brand new. There's still tags on the appliances. And they're like, yeah, we don't care. We want you to take it out. We want you to put in our appliances, our carpet color, and paint the walls our colors.
You got to be joking me.
And I was like, this is the dumbest thing I've ever heard in my life. Like, I was just like, this doesn't make sense to me. And they're like, no, we're standardizing our colors. And then I'm just like, maybe that was part of pulling out the rest of my hair. I was like, this doesn't make sense. Jonathan Gray is one of the smartest dudes in real estate that I know. And if he's the puppet master behind all of this, what does he know that I don't know? And the reality is that they were basing their purchases and their investments on the previous peak prices. So they said, hey, this area used to be worth $500,000. We'll be into that for 75% of previous peak value. And so when I was looking at it, I was looking at it in a window of today I can buy it for $200,000. If I fix it up, I can sell it for $250,000. Well, when they came in and bought it for $250,000 or $275,000 or $300,000, I was like, this doesn't make sense. They're paying 20, 30% over market value. What the heck? And so then the reality was they were like, it's going to re-shoulder off that $500,000 price point, and then it's going to be worth $550,000 or $600,000. So as long as we're buying it for under or all in for under $350,000, and we have everything standardized, our new paint colors, our roof colors, our appliances, all of those other things, we can standardize this, and then we can package it up, securitize it. And so I was micro correct about saving you 10 cents a linear foot on baseboard. They were macro correct on the market fundamentals of what was going on. And so I saved $150 or made $150 extra profit on that baseboard. They made $9 billion profit on this macroeconomics. So I was like, wow, I'm playing checkers, and I'm playing like a kid's version of checkers. And so that was exactly what I mean in that chapter about have an exit strategy in mind. And so you get into this, and this was also part of my own downfall, is I just started buying houses, and the market was so frothy that it was like going up so much. I was just like, I'm just going to keep holding on to them. What happens is you let greed get into place and you're not executing a business plan. So Blackstone or Invitation Homes at the time was executing a business plan that it didn't matter what the value was today. They were looking at a 5-year evaluation or 10 years. And so they were playing a different game to hold this in a long time period. And that sometimes if you're trying to outcompete them and your business plan is not to hold it for 10 years, you can get crushed. You can go, if you go outbid them and they're okay paying over market value because they're looking at a 10-year horizon and you're not planning to hold it for 10 years, that could be a terrible deal for you.
Wow.
Subsequently, so then it's like, okay, even if there is distress and there is the right time to buy, are there assets that I could give you for free or seller financing or something like that that would actually be a terrible deal for you? Well, in commercial real estate, absolutely. There are contaminated properties. A dry cleaner was there with chemicals and other things like that. And then you, as the new owner, the previous owner's not responsible for that. You are. So you might have millions of dollars of environmental cleanup on a building that you can't sell or finance for the next 10 years until you get this cleanup done. Became aware of it. Somebody else brought it up. And so it's like, there are properties that people are like, I'll give it to you for free, $0. And I was like, no way. It would take me $1 million to clean up the contaminated soil of that. And that's from a commercial asset. And it was in a downtown area. It was not even half a mile from like where the main street was. A lot of towns have that. And so that's why I think that you need to put together systems and fundamental first order principles of understanding how real estate is evaluated, and then kind of systematically work off of that. Have a business plan so that if your plan is to fix it up and sell it in 3 years, you know what you're doing. And of course, sometimes there's frenzied market volatility and it goes up and it benefits you, and sometimes it goes the other way. But if you're playing your game, oftentimes you don't let the market determine what you're doing. You are executing. And that's where the subsequent other Rothschild said profits are made by selling too soon. Because what happens is people are trying to time the markets. They're trying to time the bottom. They're trying to time the top. Be like, you can't. So if you just execute your plan, make your profit, because you're never going to go broke making a profit.
Never. There's a lot to be said about that. I mean, I'm an ex-Wall Street guy, and we always traded in portfolios on set rules. And those rules sometimes made no sense because you're just taking profits when you knew you could make a lot more. But that would be when you enter the greed phase. And the greed phase is where you lose money. And I think in today's world right now, we're at the end of a cycle. We are absolutely positively in a speculative bubble, whether it's the stock market or whether it's real estate, and everything's going to come crumbling down, whether you believe it or not. And when it happens, the question is going to come about, were you prepared and are you ready for the biggest opportunity of your life? And you kind of summed up some of that. So people that are ready are the people that are doing what the Rothschilds and the Rockefellers would say, selling, following a plan, executing on something that no one else understands. Like I've been selling off most of my rental portfolio. I mean, we went from 91 doors down to 14 because I've sold them off into what I think is one of the craziest speculative bubble. And we've profited tremendously in doing that. But yet other side, when people are looking at what I'm doing, they're saying, why would you want to pay all those taxes? And I always calmly answer, because I'll never be in a lower tax bracket than I am now. And because I have carry forward losses and so on. But these are the plans. It doesn't matter what the taxes are. You're always going to pay taxes if you profit. It doesn't matter whether or not you wait or you kick the can or you do, the exchanges. It doesn't make a difference. My plan is to execute today, take the profits, and get ready for what is coming next so that I can buy the distressed properties, so that I can do what you just told me, Invitation Homes and what all these big hedge funds are doing right now. Because being ready for the next opportunity is just going to be a massive win. But too many people are going all in right now because interest rates are low, which I get, but I hope most people are playing the long game if they're buying at the pricing today. So it's not even so much the pricing, it's just, can they wait? The Invitation Homes and the BlackRocks, the Blackstones, they have the capital to wait it out. If things do fall, it's just a blip in the radar. They don't care. They cash flow themselves through, and then they execute their plan at the time when it comes. But a lot of people can't execute because they can't wait. They can't make it through that season because we're coming into a stormy season. I mean, the question always comes to me is, are you able to hold this property if it loses 20, 30% of its value? Can you cash flow through that? If your rents go down 10 to 15%, is that possible? Did you run those numbers? And the answer is usually no, because they think the rents are going to keep going up. They think the pricing is going to keep going up. And then I say, well, I hope I'm wrong. But history proves that I'm not wrong. It's just what happens. But I love how you talked about that. They were playing a different game. And they're certainly playing a different game today. But the game today is not a game that any of us can play. The game today is simply, they have the cash, they have the government money, because obviously they just printed $5 trillion. A lot of it makes its way into these hedge funds.
More like, the way I've looked at it is more like $20 trillion.
Yes,
20 plus trillion. They're
playing a big game right now, because I'm not even factoring in the leveraging and everything else. I'm just talking about what they're printing. But they're able to go out and buy blocks. They're able to go out and buy entire freaking cities if they wanted, and they can buy at the pricing today because they're not playing the same game we are, and the money that they're playing with is Wall Street money that has already made tons of money. They're just playing with house money at this point, and government subsidized money as well.
To give you an example of that, so I actually, when I decided to go out on my own, I was kind of being positioned to be a director of acquisitions for one of these REITs. Is they had a $500 million line of credit from Deutsche Bank at a point.
There we go.
0.25%.
Now, let me stop you right there. Nobody understands how that's even possible, but because they don't understand Fed funds. They don't understand how you can get money that cheap. And I was just talking to another hedge fund manager out in Utah, and he was explaining this whole thing. It's just a different game. I didn't mean to cut you off, but that's so critical because people think that's impossible. It's not impossible. It happens every day.
So not only that, so they're borrowing money at 0.2%. There's another one, Lennar, had a $1 billion loan from the Bank of China for 0% interest. And so you're like, that doesn't make sense. How would anybody lend a loan at 0% interest? Well, Bank of China knows that they're going to manipulate the yuan, and they're going to make more money off of the currency exchange. And it was against San Francisco-based real estate. And so their collateral was San Francisco-based real estate and $1 billion to Lennar and the Presidio. And they're like, yeah, we'll do that at a 0% interest. And so the cost of capital is, like you said, way, way, way different when you're at 0% interest or 0.25% interest, 1% interest, when the cost of capital that you and I borrow is at 5 or 6 or 8 or 10%, so they're effectively making 10% more money on everything, and even on the leverage that they do. And then you're talking about when they securitize it. So they're passing all the risk to a bondholder, then from a securitizing to an IPO, or now with the newest thing, the SPACs, and then creating these other vehicles. So structured finance does have some very unique levers that they can pull that the average Joe Blow that does not know. And that's where I said, like, that 3.0 version of myself was, I went back to school. I went to grad school and studied international real estate and finance. And so it was like, it really gave me that private equity and structured finance. It was like, oh, I see what they're doing, how REITs are able to, and how managing a portfolio is much different. And so back to what you're talking about right now, the markets in this frothy and speculative environment. From a residential perspective, we have massively underbuilt for the last decade plus. And if you look at this from a data standpoint, because I spent a lot of time in the data, is we were overbuilding the market up until 07, 08. And so we had a surplus of a few million homes surplus, like we built too many. But because of the fact of the ninja loans, and if you saw the movie Big Short, strippers buying 5 houses and them sitting vacant. And I was, absolutely part of that same crowd down in Phoenix. And so it was just like, it went up 20% this month. Awesome. Look how much money I made on paper. And then subsequently when it crashed, it came all down. So we had to, and every year we need at least 1 million new residential homes, products, homes, apartments, whatever. And that's from net population growth, birth rate, immigration, others. That does not factor in the institutional capital that's buying some of these homes and kind of removing them out of the they don't tear them down, but so they still are out there. But call it anywhere from 1 million to 1.2 million is rough order of magnitude that most economists can agree to, that we need 1 million new products every single year of residential units. Well, we have not built 1 million any year since 2006. And so you go to 2006 and we had to burn off the initial inventory. And as we were burning that off, because we'd only built 200,000 homes, then 300, then 400 and 500. And so that delta that we had between there, and guess what, where we hit equilibrium? In 2012. And what has the real estate done since 2012? Only gone up. So because we've still continued to underbuild, we've actually had a growing amount of demand for homes and apartments and everything else, residential units. And so we're currently sitting at about 4.5 to 5 million residential unit shortage in the United States. And that's not evenly dispersed. There's parts of Ohio and West Virginia and things like that. Those are cities that they have houses sitting empty. Really what it's looking at is where these population climbs, where is population moving to, and those are having an unbalanced supply and demand. California, the Northeast, the West Coast in general is doing a fantastic job of driving people out of those areas through crazy taxes and stupid politics and whatever else you want to call it. But Boise, Salt Lake, Phoenix, Texas are, huge beneficiaries. The Northeast is sending them down to the Carolinas and Tennessee and Florida and Texas as well. And so you have this convergence of population that is aggregating to these certain geographic regions that also is constrained by supply. Now you have layered in supply chain issues, construction costs, and you cannot even build enough units to satisfy that demand. So fundamentally, we're in an amazing, amazing place from a real estate perspective, if you're especially looking at multifamily or rentals or houses. And so you're going to see pretty sizable increases of rents and values, but that only factors in for the fundamentals. Mm-hmm. Fundamentals are not the only thing that drive markets. Where Howard Marks, he wrote a book, Mastering Market Cycles. And there's one of the things that goes into it is consumer sentiment, or the how people feel is another variable or offset to that. When people feel frenzied and there's market fundamentals, you get these huge spikes in value overall. But sentiment goes away. It doesn't really matter what the fundamentals are because people are irrational. They don't look at the data. They don't make these decisions. They go, stop buying, hoard cash, go buy all the toilet paper. You've seen people do like stupid stuff. Like you're like, why are you buying all this toilet paper? This makes no sense to me. But with gas, with all these other things that are happening with war, is there going to be, World War III? That could very much change the consumer sentiment and really what exactly to your said, cause a shift in the way that, values are looked upon in the future. The Fed increased the rate or saying a little bit. I mean, you're looking at it, it's still nothing. And people are like, oh, I don't know. Inflation's high. The cost, less and less people can afford to buy a house. And so I think what that is going to do is potentially cause the music to slow down and maybe in some markets even stop. So to your point is, can your valuation, or your property or asset cover higher interest rates? Some of these bridge loans that were in IO, and it goes up. Can it sustain and do a stress test on your analysis? At what rent number or decline are you now in trouble and losing money? There's covenants in a lot of these commercial mortgages, not as many in the residential, but a lot. If you don't have certain debt coverage ratios, they'll demand you put more money in.
It's like a margin account.
Yeah, margin call. Excuse me, you need to put another $1 million into this property right now. And you're like, hey, I already put that down payment. But like, no, your rents have gone down, your valuations have gone down. We demand more money. And so then, you need to start looking at some of those variables in this time that's more stormy, turbulent. And what about higher interest rates? What about flat rent growth? Or maybe it's not the record rent growth that you're projecting because there's, population declines are moving. Are you investing in the Northeast or maybe some snowy state that people are like, I'm over this. I can remotely work anywhere. I'm going to go remotely work in Florida. I don't want to live in Minnesota anymore.
Listen, like what you said, and you were going, and I was just holding my tongue, and I was like, all right, I think there's more to the story. You're talking about all the things I've heard over and over and over again about demand and how many houses they didn't build and the shortages. And I was waiting. And then finally you went where no man or woman that I've had on this show went, to the thing that really drives consumers to make decisions: sentiment. And I'm glad you brought that up about that book. I read a ton, but see, I was actually in the Wall Street world through 2 recessionary periods, and I understand sentiment. I understand it to a level that most people don't, especially today, because that sentiment, and just so everybody's clear, like we're talking real estate here, and real estate, I just want to make sure everybody understands my standpoint. Real estate to me is the single greatest investment of all time. Bar none. There is no better investment than real estate, and there may never be. I mean, but the thing is that you have to understand is the stock market, which is where the majority of people's wealth is outside of their homes. But we'll skip that because your primary house is not an asset; it's a liability. You're talking about the stock market, and when the stock market lets loose, which indeed it will, when who knows, but when it does let loose, first thing that kicks in is fear. People will have fear. They will be fear stricken, which starts the sentiment. They start thinking, oh my God, how much lower can it go? Should we get out now? Should we save what we have? And then you'll see a selling frenzy. But then what happens is a second phase, it's a domino effect, is that fear leads to reactions. Okay. Those reactions are people sell, which then leads to reality. Reality is people start losing their jobs, to get laid off. Every recessionary period, just look back to COVID. It was different, but same idea. People lose their jobs. So that takes away their income. Yes, they've got Social Security and incomes from unemployment, but it's not enough to live that lifestyle. And everybody right now is upping their lifestyle because everybody feels rich because their assets are going up, their houses going up, they're accessing home equity lines, and their incomes are going up because inflation drives rising wages. And what rising wages, the government loves it because it increases the tax roll automatically. It's like a beautiful system the government has. Let's print money. Let's drive inflation. Let's pay our debts back with pennies on the dollar because inflation weakens the dollar. And then let's increase the tax base just by getting people to make more money. But when all that comes crashing down, and as you said, the music stops, the sentiment becomes very important, because when people lose their jobs, watch their portfolios drop 20, 30, 40%, and go through this whole thing, they will sell, which will then trigger, it will take all the emphasis off this lack of demand and everything else, because people can't pay the prices that they are today, which will deleverage and deflate the entire market, which real estate values will come down, making for an awesome freaking day for you, myself, and all the people that you teach and everybody you're talking about, because, hey, we get to take advantage of cheaper prices and buy again and repeat the cycle.
Yeah, and it depends on, and the reason why I talked about commercial is because in the residential space, most people have equity right now. They have equity in their homes. And so where the alternative to the subprime, meltdown was people were over leveraged. And so when the values went down 10% or 20%, or even just it wasn't going up 20% anymore because they took out a 105% loan, is they were in trouble. They couldn't sell it. And that led to this contagion of fear of foreclosures and this massive, parlayance of that. So when I look at it I don't see this in the opportunity laying in the residential space. I see it much more in the commercial space. As people have syndicated deals, as people have taken the Jobs Act and used and raised some funds, and maybe in the future that will be regulated, who knows, but the reality is, like, they're trading at prices that are speculative, and when I say speculative is I need rents to go up $50 or $100 a month on my asset in the Midwest that is not appreciated in 20 years. In the last 3 years, it's appreciated more than it has in the last 3 decades. But I'm going to bank on that same last year, 3-year speculation, and it's going to do that again. It's going to double in value in 3 years. That's where I'm not smart enough to be able to understand how people are doing that, or it's really what it is who's willing to take a lower margin and a higher risk. And so because of my experiences is I'm looking for, rule number 1, don't lose money. Rule number 2, see rule number 1. And so when that goes back to it is don't lose money, is you need to protect your downside, and you need asymmetric risk profile. As if I'm going to win, I need it to be a big win. If I'm going to lose, it's a little loss. And that's where also portfolio management becomes very important as well, is because then you can start balancing out and calculating where those risks are in your overall portfolio and asset types. I'm actually kind of bullish right now on some hotels. I think you can buy them. The pandemic PPP, EIDL, printing of money, papering it, put it out there, caused a lot of them, gave them a brief window of or to hold on and not have to sell it at massive discounts, because never had occupancy gone from this to zero. They got a little uptick in the market, and so they have a little bit of cash flow. Now there's opportunities. And I think when you can go buy things at under the intrinsic value, under the sticks and bricks cost of it, and then implement some of these plans, layer in technology, layer in some of these disruptive things, that you can actually create a really strong cash flowing position that can then bolster the other side of your portfolios. I'm a seller at sub 4 caps and 4 caps. I am not a buyer of that. I'm a buyer of 10 and 12 cap properties, and then I'm just going to rebalance out my portfolio as a whole.
So with this, how are you finding these deals?
You can find good deals or distressed opportunities all times, even in frenzied markets. People have things that happen. I mean, they have divorces, they have, health issues, they're aging. And that's one of the other things is
more specifically though, the commercial stuff. I didn't mean to cut you off there, but the hotels and the buildings, like the one, on your website that we were talking about previously.
So
how do you find those?
Has to do with relationships. You have to do the work before it's time. And so do the due diligence on some of these assets. Some of my best deals took 3 or 4 or 5 years of building that relationship to the seller. And then they're like, we're ready to sell now. And consistently communicating with them and preparing for that. And so I was doing my homework for that property or those buildings before they ever came on the market. And it was, Grandpappy told me never to sell. We're just holding on to it. Now this little blip of pandemic showed them, they're like, this isn't going to maybe go up forever. Maybe this is the time to sell. We don't want to do that value add component to the building, or we have owned it. We're getting older and we don't want to deal with the construction world and the cost of fixing it up and doing those other things. But what it is I was doing the research on that 2, 3, 4, 5 years ahead of time. I identified in these markets is these properties are ripe for acquisition because they're owned by out-of-state, owners, or it doesn't fit their overall investment profile or something along those lines. And so I have an office building that we're turning into apartments, but I bought it at, under the replacement value. And so I'll be all in under what it costs a brand new apartment. And so it's like, that's where my hedge is so I'm looking at these opportunities. It ended up being an opportunity zone as well. And so we're also playing a 10-year investment horizon. And so we can take some of those capital gains, get some discounts on them, and then leverage them for no future taxes on the gains of this building. And so again, it's a different game. It's a different model. And we're playing it differently than these others. And then some of them is now using technology to start harvesting and creating market dynamics and start communicating. You can text, some of these, just as wholesalers do on the residential side. Hey, Chris, do you want to sell your house at 123 Elm? I'm interested buyer. Well, now you can also do that on the commercial side. Hey, Chris, pull up Reonomy, CoStar, get a listing, skip trace them, do the same principles in the commercial space. And they're oftentimes pretty happy because they're not getting hit up by 50 people a day. They're not getting mailers. And so then we put together is, here's the 50 or 100 or 250 potential properties that we're interested in that fit our criteria. Now let's create a marketing campaign towards them. Let's text them. Let's put out a mailer to them. Let's do this. Let's create some mechanisms that at least get us in the space and the conversation so that when they do want to sell, we happen to be there, or they think of us when those opportunities arise. And then we're also preparing and doing our homework, just like you should be doing for distressed real estate. Start collecting rent rolls. Start collecting anything that you can get. Get the comps on the building next door. Get the service contracts on what the buildings are next door. Know what the market fundamentals are so that when you go into that, because you may have limited information when it comes into a distressed situation, they may not have accurate financials. They may not have the same OM that you're expecting to see on a deck from a deal. And so, but if you've been started assembling and putting those things together ahead of time, then what happens is you have the capabilities to move faster than anyone else. And so if this is a home run slam dunk deal, which that's what is super awesome about in the distressed environment, is it's kind of like shooting fish in a barrel. You'd be like, which of these 3 deals should I do that are going to make 50%? And then sometimes it might be, we should do all of them. Because people get alligator arms, they react and the sentiment goes in the other way. And so then you create another opportunity to really dive in and create, which could be life-changing amounts of wealth in a very, very short time period in these down markets, buying when there's blood in the streets. Now, use leverage. Leverage, and I mean leverage not in the sense that you and I were just talking about as leveraging on a mortgage. Use leverage of other people. Use other people's expertise. You do not have to know all of these things. I have been a professional investor for 20 years now. I told you earlier that I have, I've got a master's degree in real estate and finance. I've written books on it. I have a broker's license, and I don't do everything because that would be so stupid to think that I had, more collective knowledge than the industry as a whole. Assemble a team. Get real estate attorneys that understand this. Get, capital markets people that understand the financing, and it's a fluid environment. Getting, expertise in that particular building type, the type of HVAC. Is it a cooling tower? Is it a, VRF system? Those things have very technical details that can make or break an investment into that. Utilize and leverage other people's knowledge. And real part of the reason I wrote the book and this discovery is leverage of other people's wisdom. A book is by far and away the best thing that you could ever do to supercharge your education, because when you read a book in 3 hours or 4 hours or 5 hours, maybe you're super slow and it takes 10 hours to read a book. But what you're getting is oftentimes someone's 10 or 20 years worth of experience condensed and down to a 3-hour version. This podcast, you get a scratching of the surface. Yeah. Go to a panel or speaking of a thing, watch a YouTube video. You're getting surface level of that. A book is going to give you 1 to 2 decades worth of wisdom and knowledge on a particular topic that you're interested in. And that is where you can start supercharging your understanding of a topic that also allow you to start assembling teams and preparing before the distress actually happens. When it happens, it's kind of almost too late, unless you're the Blackstones of the world.
I love it. I love the talk about relationships. It's almost, sometimes I feel like it's a dying thing. People are at such a digital phase. They're just not focused on those longer term relationships that pay you those big rewards. Like you just mentioned, it's such a huge thing. So like with where we're at right now and where we're going, like what are the big plans or what are the big pieces of advice you could give to people in terms of a few steps they could start taking right now? I mean, outside of reading books, like obviously they should read your book, but like where should a starting place be for the audience?
So I think one of the biggest things is defining what you want to do or the deal specifics and really getting into. So when I go share out to brokers or talking to people, I have a very specific criteria of what I'm looking for. I'm looking for 50 to 125 key roadside motels or hotels that are mom and pop operated. If there's a flag, there's a Days Inn, Super 8, Roadway Travel Lodge that I can deflag. It's in a tourist transient market that's drive to 3 hours within a metro. It's a cosmetic fixture. It's not structural or heavy value add because I don't want to add onto the building and I want to just clean up the insides. And then, from those things is that like people can bring me those deals because they know very specifically in a very narrow window of what I am looking for. And obviously, depending on my investment thesis, or particular criteria, we do land assemblage. So that investment criteria for land is different than the one that would be for a hotel or an office product. And so what happens is people get, and especially early on, and people that are transitioning out of residential or getting into commercial, they don't really have anything to find. So they just kind of go, I want a good deal. I don't know what a good deal means to you. So the more specificity that you can get to what is it that you are looking for, and it even comes to that point of like Alice in Wonderland that talks to the Mad Hatter, like, where do you want to go? And be like, I don't know. Then it doesn't matter which direction you go. So if you want to get started in commercial real estate, you have to kind of pick something to start with. You have to pick something that, and I would say, when you start understanding yourself of what excites you, what fires you up? What are the things that you would keep you up all night long? It's so exciting that you have to tell or convince yourself to go to sleep. I'm so excited about looking at these net lease centers in the Midwest because look at how passive this cash flow is and you're trying to get, and you're so excited about it and that's something and that fires you up, you should maybe pursue that. And then if you actually take it from what is it that you're trying to achieve in your life? Why do you want to make money? Money's fake. Be honest with you, and the government, is pretty identifying, is money is fake. It is a made up and a faith in a system that they're going to pay off of a debt. It used to be tree bark. Paper money was tree bark from Kublai Khan and then Genghis Khan, and then it's spread from there. And so money is a faith in a system. And so time is real. You can make more money, you can't make more time. Right. So if you can get back to the first order principle of like, what is it that you want to do? And I'd say, not everybody needs to be a millionaire. Well, maybe you do because inflation and it's going to cost you $1 million for a Big Mac. But I was like, that may be the factor. But I was like, what you want to do is you want to be wealthy. And wealthy means that you have removed yourself from the economic gravity of the market fundamentals. Gas prices go up, they go down. The stock market goes up, they go down. But if that has no effect on your life and your livelihood, you are in a position of wealth. And so establishing is what is that you really want to do. And then you can start creating reverse engineering. You may only need to make $250,000 passive a year. And you could live your dream life. Travel around in an RV, teach your kids in a homeschool, go spend 6 months surfing in Nosara in Costa Rica.
Dude, now you're talking my language. My buddy's in Nosara right now.
So I was like, literally like that could be your jam. And that might only be $250,000. But if you come in and you're trying to do a $70 million apartment complex as your first dealer, that's what you really want to do. And the stress and the other partners that you have to bring in and the leverage and the debt that you have to expose yourself, be like, why? And they're like, well, because I can make $10 million. Be like, but your goal is only $250,000. Stop trying to chase something just because it sounds good or it's glamorous. Play your game, and you have to define as what is your game, then is what excites you. Now start getting specificity around that, and then you can start reverse engineering and putting together a plan, and then start doing your homework on that. Start leveraging those books, leveraging brokers, building those relationships in that space. And then what happens is you'll see that when you start operating in that principle is the universe, God, is something, it starts flowing through you. Those opportunities will start presenting themselves. The more ambiguity you have in the world, the less that you're going to get. The more specificity, the more you're going to get that. And I'm going to call you up, Chris, I heard you wanted this hotel in a rad tourist market that needs to be remodeled. Here it is. And it's $2 million. Because now somebody knows how they can add value to you. They know how to give you opportunity because you declared that and put it out there. And so those are the things that I see so many early investors, early people that are venturing into this space don't do. And then
that was good.
There's going to be something else on that. And I'm going to say default aggressive. I was at Jocko Willenick's leadership training thing at Echelon Front. Default aggressive action. 80% of all of this, 90% of it is action. Anything you bought in the last decade by being default aggressive probably led to massive amounts of wealth creation, even if you didn't know what you were doing. I was like, we're getting close here, but I'm going to tell you a story about how being default aggressive and really limiting mind beliefs and limiting mindsets can play to this. So I have this goal and this vision of building a skyscraper. Maybe it's a phallic symbol or whatever it is. I think that's super rad to build a skyscraper. So I went back to school. I was down in Miami because I went to FIU. And I'm on the real estate council there. And I met this young kid, 28, 30, somewhere in there. I don't know his age exactly, but kind of young-ish. And he just finished building a 45-story condo project. And he made $30 million profit on it. And I was just like, tell me more. Like, what, did your dad, grow up in the construction industry? Did you have funding? Like, how'd you do this as your first project? And he's like, nah, I just got to the country 3 years ago. I was in Venezuela. I have no experience in construction. My dad, we had no money, literally, we were starving. We came to this country 3 years ago without a nickel in our pocket. And I was just like, this doesn't make sense to me. What are you talking about? And he's like, so I just went and I saw a piece of property in Miami Beach on LoopNet, and it was listed for this amount of money. And so I wrote up an LOI and I put it in contract. And then I saw that there was a contractor down the street, and I saw that there was an architect sign on that. And I said, hey, could you guys do that for this project or this property over there? And they said, yeah, that looks great. We could just kind of replicate and do pretty similar. And here's what the numbers would be. And it's $70 million. And he was like, great. So then he started going to meetups, walking around, telling people, hey, I got this project. I'm going to do this. I'm going to do these. Here's the contractor. Here's the architect. And other investors showed up. And then they started pre-selling all the condos. And then while they're in contract, they funded it, got financing, and sold out the entire project. So then he basically just listed it for more than it was worth, or more than the cost from the contractor. And so he sold it for $120 million worth of all of these condo projects. His net cost came down to, and so he made $30 million. The first project that he's ever done 3 years ago with no experience, with no money, with no education, anything. And he did what was my dream project because he just did it. And it hit me over the head like a 2x4. I was just like, how much of this is my own limiting beliefs that said I have to do $100 million worth or $200 million worth of assets under management before I get to this level and this many deals and these other things. And so the reality is everything in life is the limitations or self-limitations that you put on yourself.
Wow. I couldn't agree with that more. So as we get to the end here, I got a question for you based on what you just said. What's been your biggest obstacle on your journey?
I think it's always myself. Is the reality is we all have this inner dialogue that is, you know, and honestly, like if somebody talked to my kids or my wife or things like that, the way that I talk to myself, like I would do violence on them. Like it is crazy how bad that is. And so what you have to do is you start having to work on your mindset. And so oftentimes people think of this as they think they're in a reactionary period. Something super bad is happening. Oh my gosh, emergency. I was in that place and I was in an environment where I was reacting. I'm losing everything. Things are being foreclosed on. I'm doing work on, someone I hate, the boyfriend of the girl that I was going to marry. And so then what happens is you have to start elevating. What happens is now you're not in that reactionary period, but you're kind of in a negative mindset overall. Then when you evolve from a negative, then what happens is you're not in that environment, but you're like, hey, maybe anything could happen, but you're also thinking, but probably something bad happens. I don't know if you've heard this and heard people say this, knowing my luck, it'll not go right. So what happens is they're out there projecting to the world that they think, and then they're looking for, knowing my luck, it's gonna go bad. And then what happens is you have someone that's at a negative, like a default neutral. Anything could happen, and I don't know what the possibilities are of that possibility. So it's like, I don't know, roll the dice 50-50, something good, something bad. Then what happens is once you get above that is anything could happen, but you expect something good to happen. Anything could happen, but probably something good's gonna turn out. Then what happens is you can move above that to, not only do I expect something happening, but I'm starting to look at that. Like I expect something to happen. And not only that I don't think it's going to be, I'm making something happen. Then you start planning out and then creating an environment and a mindset that says, this is what I'm going to do. This is the purpose and the passion that I'm following. And I'm creating an action item towards that. And so I am manifesting my own reality. And then what happens is you've elevated your mindset time and time and time and again. And it's a journey. And I'm not saying just because you get to this, you're going to be in that area or that mindset in all areas of your life. And so what happens is an environment of putting yourself in this, not really, I'd say enlightened or woo-woo, but it is elevating to like, I feel more alive when I am doing and pursuing the things that drive me, that give me energy, and then move me forward, and then also challenge me beyond my comfort levels. And so then I am creating the environment that I know it is going to be abundant. I know that these things are going to crush in so many different areas. And so then creating those opportunities, and then the universe kind of comes in line. And so my biggest issue has always been me. 100% it's always been me. And then it's also understanding, and the ego is removing that from myself, is I don't need to be the superstar of this. I don't need to actually do this work. Putting integrators into the organization, trusting my team, leveraging, and I said that earlier, leveraging other people is 5 people are going to be better than 1. 10 people over the extrapolation long enough period of doing almost anything are going to be better than 5. And so then when you understand that this is like the collective is getting and building teams, getting people that are trustworthy and you've aligned with your same vision, you can do anything. You can conquer the world. You can fly to Mars if you wanted to.
Well, that's going to happen because somebody had that vision and takes that action. His name's Elon Musk. I bet you any money that dude goes to Mars, but that's because he took action. So folks, as we wrap this episode, it's time for you all to take action. So real quick, Jake, how do people take action with what you're doing? I mean, short of just buying your book, which they can get on Amazon, I would assume, what other action can they take to learn some of this stuff that's in that wise mind of yours?
So catchknives.com, that's where they can go buy the book. We actually just put up a net lease due diligence course because I see so many people just exactly to your point, aping into stuff and they don't understand what they're getting into. Sign up for that if you're looking to get into commercial real estate or net lease that particular space. They think that it's passive. I'm just going to buy this, sign up for $6-8 million worth of personally guaranteed mortgages and everything should be fine. Tell that to the Sports Authority, real estate holders. Sports Authority doesn't exist for those people that maybe don't know or miss that, like when your tenant goes away, what do you do with an empty concrete box? And so that's a way you can tap in. At jake.realestate on Instagram is where I'm most active. And I know that I have some YouTube channel out there and LinkedIn. You can go to LinkedIn and follow me and see some of these different contents. But I would say direct access is Instagram. Follow me there. And then the Catch Knives, you can sign up for the mailing list. And then we put more and more content and we're building upon this. We'll probably launch I think they're pushing for 3 more courses this year for other things particular, because of distress and doing due diligence and preparing, assembling your team. And so we're going to keep pouring into that. And mostly that's going to be through that mailing list.
Fantastic. All right, folks, we're going to put all those links in the description so you guys can work with him and take advantage of everything. At bare minimum, get his book and read it. That is taking action. And that is what you need to do because knowledge isn't going to get you anywhere in life. It's the action you take on the knowledge you just got here. So with that being said, folks, thank you for joining us for another episode, and we will see you next time.